Taxes may not drive every investment decision, but they shape the landscape every investor walks across. A portfolio isn't just about what it earns, it's about what it keeps. For the exam and in the real world, understanding how different types of income are taxed is central to understanding how money grows, how it's preserved, and how it's transferred. Let's start with the three broad categories of investment income: interest, dividends, and capital gains. Interest income is the most straightforward. It's taxed as ordinary income at the investor's marginal rate. That means corporate bond interest, treasury securities, and bank CDs all fall into the same bucket. Municipal bond interest, on the other hand, is generally exempt from federal income tax and may also be exempt from state and local taxes if the investor resides in the issuing state. However, that tax advantage doesn't extend to capital gains. If you sell a municipal bond at a profit, the gain is taxable. Dividends come in two varieties: qualified and non qualified. Qualified dividends are paid by U.S. corporations or certain foreign companies and meet specific holding period requirements. They receive the favorable long-term capital gains rate, typically 15% for most taxpayers. Non-qualified dividends, by contrast, are taxed as ordinary income. That includes dividends from REITs, money market funds, and many preferred stocks. Then there are capital gains and losses, the profit or loss realized when an investor sells an asset for more or less than its cost basis. The cost basis represents what the investor paid, including commissions or adjustments for reinvested dividends. If an asset is held for 1 year or less before it's sold, any gain is short-term, taxed as ordinary income. If it's held for more than 1 year, it's long-term, eligible for lower capital gains rates. The difference matters. A 1 year and 1 day holding period can be the dividing line between ordinary income taxation and a significantly lower rate. When multiple purchases of the same security occur at different times or prices, the investor can choose the method of cost basis calculation. First in, first out, FIFO, assumes the earliest purchases are sold first. Specific identification allows the investor to designate which shares are being sold, usually to optimize tax outcomes. Average cost, often used with mutual funds, takes the total cost of all shares divided by the total number of shares. Losses can offset gains. If capital losses exceed capital gains, up to $3,000 per year may be deducted against ordinary income, with any remaining losses carried forward indefinitely. There's an important trap for the unwary investor: the wash sale rule. If a security is sold at a loss and repurchased within 30 days before or after the sale, effectively 61 days total, the loss is disallowed for tax purposes. Instead, that disallowed loss is added to the cost basis of the repurchased security. The intent is to prevent investors from claiming artificial losses while maintaining their positions. Another tax area worth remembering is the distinction between tax-deferred and tax-free growth. Tax-deferred investments, such as traditional IRAs, annuities, and qualified retirement plans, postpone taxation until withdrawal. Tax-free investments, like municipal bonds or Roth accounts, may avoid taxes altogether under certain conditions. Now, let's move from traditional investments into alternative products, the instruments that fall outside conventional stocks and bonds, but which the Series 7 expects you to recognize. REITs, or real estate investment trusts, are corporations that own and often operate income-producing real estate. They're required to distribute at least 90% of their taxable income to shareholders each year, which allows them to avoid corporate income tax under Subchapter M. Those distributions are generally taxed as ordinary income to investors, not as qualified dividends. Direct participation programs, or DPPs, pass through income and losses directly to investors. Limited partnerships in real estate, energy, and equipment leasing are the classic examples. They offer potential tax deductions for depreciation and depletion, but also carry liquidity and operational risk. The key feature is that profits and losses flow through to the partners. The entity itself doesn't pay taxes. Hedge funds fall on the opposite end of the spectrum. They're private, unregistered pools for accredited investors, those who meet specific income or net worth standards. Hedge funds often use leverage, short selling, and derivatives to pursue absolute returns. They're taxed like partnerships, passing income and gains through to investors, but without the transparency or liquidity of mutual funds. Then there are structured products, the engineered securities that combine traditional investments with derivatives. A structured note, for instance, might link its return to the performance of an index, a basket of stocks, or even commodities, while guaranteeing a portion of principal. The underlying components determine its risk, and the tax treatment follows the income type generated by those components. A close cousin is the exchange traded note, or ETN. An ETN is a debt instrument issued by a bank tied to the performance of a market benchmark, but without ownership of the underlying assets. ETN returns are typically treated as capital gains when sold or redeemed, not as interest income because there are no coupon payments along the way. Other alternative investments include commodities, private equity, and real assets such as precious metals. Their tax treatment depends on structure, but they all tend to introduce greater volatility and complexity, factors that make them suitable only for sophisticated investors. From a suitability standpoint, alternatives can serve as diversifiers. They often move differently from traditional stocks and bonds, providing a hedge against inflation or market shocks. But they also come with liquidity risk, valuation uncertainty, and sometimes opaque tax reporting. When you see these products on the exam, look for cues about investor sophistication, risk tolerance, and liquidity needs. A limited partnership or hedge fund is never right for someone who needs ready access to funds or who cannot tolerate substantial risk. Finally, let's circle back to a recurring Series 7 theme: tax efficiency. Tax efficient investing isn't about avoiding taxes, it's about structuring returns in the most favorable way possible. That might mean using municipal bonds for high income investors, holding growth stocks for more than a year to qualify for long term gains, or using retirement accounts to shelter high turnover or high yield investments. The exam doesn't expect you to prepare tax returns. It expects you to understand how tax treatment affects investment performance and how to recommend products that match a client's profile both before and after taxes. Taxation is the quiet counterpoint to return. It's what turns gross yield into net yield, what converts growth into usable income. Every investor lives with it. Every representative must understand it. And as we move forward, we'll turn to the final stretch of this series: how markets are structured, how orders are handled, and how regulation protects both investors and the integrity of the system itself.